Good day, traders and investors. In this episode of Simple and Short, we're going to talk about one of the most important forms of technical analysis. It's so fundamentally related to good technical analysis that we can compare its importance to the one of support and resistance. Part of the reason why is because very often this thing can act the same way as they do. In this lesson, we're going to talk about the moving averages. Moving averages are very important for every person who wants to become a successful trader. The reason for that is that they serve many functions. As we've mentioned, they can serve as a support or a resistance, but they can also be used to confirm the trend, determine reversals, and also spot periods of uncertainty. My name is Damien, you're watching the channel of the Road to El Dorado. Let's get it started. Once you're on the chart, the first thing that you need to do is to add the moving average. You come over here to where it says indicators, you come to the search and you type in moving and then average will appear. There are different types of moving averages, but today we're going to discuss the most commonly used one, which is the simple moving average. Is the one over here saying moving average, simple. You click it once and then you close this window. You can notice that after you selected this indicator, a line appeared across the chart. This is a moving average. The moving average is a statistical indicator that measures a period of data and helps to smooth it out by showing it in a form of a line. This period of data is something that can be selected. By default, when you add a simple moving average, the period is 9. You can see it. Over here it says SMA 9. This 9 means that at any given time, the moving average takes in consideration the previous 9 candles, it adds up their closing value and divides it by 9. This is how it's calculated. If the period was larger, say it was 20, then at any given moment it would have taken the closing data of the previous 20 candles, added it up and divided it by 20. Speaking of 20, let us change the period of our moving average. I'll tell you in a bit why we're selecting 20. So when you want to change the period, you come over here at the top left where you have your indicator, you bring your mouse over it and you click on the settings button. As you do this window appears. First it takes you to the style. From here you can change the color. We're going to put it on red so that it's a bit more visible. And then we go to inputs. Now over here on length you can select the period on which the measurement is done. As we said, by default it goes at 9, but we want to set it to 20. Once we place the period we want our moving average to have, we just click on OK. Look now. See how the moving average changed. This is because now it's calculated from a larger sample of closing prices of previous candles. So let us give a quick example. Let us zoom in on this candle right over here. We're going to indicate it with a vertical line. We said that when you're using a 20 period moving average, the value of the moving average will be calculated by adding up the closing value of the previous 20 candles and dividing them by 20. So let's see what this means. Starting from this candle over here, the measurement will be done based on the candles in this region in the box over here. This is 20 candles. If we add up their closing value and we divide the number by 20, we're going to get the value of the moving average on this candle right here. Now imagine that with every consecutive candle, the moving average will do the same calculation for the previous 20 candles. And in doing so, it's constantly getting new values which are drawing this line that we can see on the chart. Having this clarified, let us discuss the usages of the moving averages. The first and most important usage that we need to discuss is that moving averages can act as support and resistance levels. Here I want to tell you that you can type in whichever period you like on the moving average. But there are some periods which are considered to be well respected from traders all across the world. 20 is one of them, and this is why we chose it. You can say that while the moving average is located above the price, it serves as a resistance, and if the moving average goes below the price, it can serve as a support. Look at the region starting from over here. The moving average went above the price, which meant that it acted as a resistance. The price hit it here, it encountered the resistance and dropped. Hit it here, encountered resistance, dropped. Another time over here and over here and over here. Now at this stage it finally broke it. There was some period of fluctuations above and below it, and from this point onward effectively the price was above the moving average, which meant that now the moving average was acting as a support. And so it did. Notice, it hit it here, bounced up. Hit it here, bounced up. Hit it here, bounced up. This property that the moving average can act as a support or a resistance is valid for all different kind of time frames of the moving average. It's valid for the 20, but also for the 50, the 100, the 200, and so on. So let us discuss some of the other usages of the moving average. As we've mentioned earlier, the moving average can also be used to identify the trend, show us reversals, and indicate periods of uncertainty. Let us first talk about how the moving average can help us to confirm the trend. Long story short, if the moving average is located above the price attempts to break it at least once but fails, and then we get to a point in which there is distance between the price and the moving average, this indicates that the price can be in a downtrend. Over here we can notice that we had fluctuations up and down above and below the moving average, but from this point over here the moving average went effectively above the price. Here we got this first test with a failed breakout, and from this region right over here this 20 period moving average indicated that we were in a downtrend. You can notice that the price kept on dropping down. Opposite to this, if the moving average is located below the price tests it at least once and fails to break it, and then we get to a point in which there is distance between the moving average and the price. This can be taken as a confirmation of an uptrend. We have such a situation over here. The moving average went below the price tested it once over here but couldn't break it, and over here we got a situation in which there was distance between the moving average and the price. This is a confirmation that the price may be in an uptrend. So moving a bit further, you can notice that the price kept on increasing from here. Now, one very important thing regarding the moving average is that you can add several moving averages on the same chart at the same time, and those moving averages can all have different periods. When determining the trend with the assistance of moving averages, to get more certainty, you may want to use 2 or even 3 different periods of moving average. We said that the 20 is a very commonly used period, but so is the 50. So let's add the 50. This blue line that appeared on our chart is the 50. The red one is the 20. So how do we confirm the trend with 2 moving averages? Principle is more or less the same. You need both moving averages to be above the price. For a downtrend, you need the 50 to be above the 20. You need the price to test the 20 or the 50 at least once, and then you need a situation in which there will be distance between the price and the 20, but also distance between the 20 and the 50. We got the same situation right over here, where the red one was giving us a confirmation. This double confirmation with those 2 moving averages gives even more certainty in the possibility of a drop. Opposite of that, for an uptrend, both moving averages need to be below the price. 50 needs to be below 20. The price needs to test the 20 or the 50 at least once, and then rebounds to the upside. And then we need to get to a point in which there is distance between the price and the 20 and distance between the 20 and the 50. Again, we got it right over here, which indicated a possible movement to the upside. We can notice that the price went up, consolidated for a while, and went up even higher. The next usage of moving averages is to spot reversals. This usually is done with couple of moving averages, and 20 and 50 are often the top peak. To get a reversal from a downtrend to an uptrend, you need a transition. This transition is composed out of two elements. The first element is that you need the two moving averages to move from above the price to below the price, and the second element is that you need them to cross. Notice how over here we had the blue one above the red one, so the 50 above the 20, but from this point over here we started getting the 50 below the 20, and both of them were now below the price. You could say that this point in the region right over here indicated that the price may be switching from a downtrend to an uptrend. For more certainty, you may want to wait for a retest and a rejection so that you can also get the gaps between the price and the moving averages to also have a confirmation of the opposite trend. Now, moving further, notice what we're getting over here. Look how over here again we got a cross, but we didn't got the condition where both of them were located above the price. This means that we were still not getting conditions of a reversal to a downtrend. You can see that the price kept on consolidating and then kept on moving to the upside. If we track the price further, you can notice that over here we got a cross, and this time both of the moving averages were located above the price, which was now a proper indication of a reversal to the downside. So, moving further, we can notice that this produced an enormous drop. One more function that the moving average has is to indicate periods of uncertainty. Now, this is a very simple and straightforward thing. Whenever you encounter a period such as this one, where the price is fluctuating above and below the 20 and the 50, this shows indecisiveness on the market, and it tells us that currently there isn't a specific trend. In moments like this, you may want to avoid placing any trades, as the market doesn't give us much certainty on whether it's moving in an uptrend or a downtrend, and this is going to be a problem for a lot of different trading approaches. To start trading with more certainty, you may want to wait for a period like over here where we're getting a confirmation of a general downtrend, or opposite to that, an uptrend. You have one more example of uncertainty. It happened in this region right over here. As the price was moving up, over here we got into a period of uncertainty. Again, we couldn't define if the price is considered to be in an uptrend or a downtrend. Now, we know that over here in this occasion, the price continued moving in the same direction as the movement that led into this consolidation period. Long story short, the way that you can use the periods of uncertainty is to simply stay away from the market until you get a more obvious direction. Finally, I want to explain to you a simple strategy with which you can use the moving averages for trading. I don't know if you are familiar, but if you are trying to take trades in the same direction as the general trend, this on its own can increase your chances for success. Statistics show that whenever the price does a correction against the general trend, it has a 60% chance to reverse and continue with the general trend, compared to just 40% chance of reversing the trend. Having that said, I'll explain to you how you can trade the moving averages by going with the trend. Over here we're looking at the period in which we had a well-defined downtrend. We could define it from this point right over here. Now, as we are getting this indication of a general downtrend, what we're looking for are occasions in which the price will correct to the upside, test either the 20 or the 50, and around those regions we are going to look for circumstances that are giving conditions for an entry for a sell trade. A sell trade because a sell trade is in the direction of this general downtrend. So look over here. This is the first test that we got, and if we zoom in on it, you can notice that this was actually a bearish engulfing. The closure of this candle gave an indication to enter a sell trade, and as you can notice, the price produced a great drop. Moving a bit further, over here, the price tested the 20 again. Now we can notice that this candle over here gave us a shooting star candlestick pattern. The closure of this candle indicates a possibility of a drop, so assuming that you took another sell trade over here, again you would have caught it as the price dropped lower. We have another one over here, again a test, again a bearish engulfing, and again a drop, which is another movement that you would have caught. Finally, at this point over here, again there is an engulfing, again the price produced a good drop. Now we can notice that after those 4 consecutive profitable movements, the price started fluctuating up and down above the 20, then the 50, and entered a period of some uncertainty. The same can be applied the other way around for a bullish trend. I hope that you've enjoyed this video and that you find it helpful. If so, please subscribe so that you can receive notifications whenever we post new educational videos. One extremely important thing to mention before we go is that the moving averages can be extremely important for making good technical analysis, but like any other separate form of technical analysis, it's not sufficient on its own, and it needs to be combined with other forms of technical analysis so that it can provide a few confluences for good setups. I'll see you next time.